Hello everyone and welcome to the channel. Today we're diving into a major development that's sending ripples through global financial markets. The US dollar index has just fallen to around 99.50, marking its lowest point in months. But here's the twist that's confusing everyone. At the same time, expectations for Federal Reserve interest rate cuts are actually decreasing. It's a paradox that has investors scratching their heads. How can the dollar fall while rate cuts are becoming less likely? What does this mean for you as an investor and for global markets, commodities, and even crypto? In this 10-minute analysis, we're going to break down exactly what's happening. We'll explore why the dollar index is slipping, why the Fed isn't rushing to cut rates, how this complex situation impacts everything from stocks and gold to emerging markets and international trade, and finally, what you should expect in the coming months. Let's get started. First, let's talk about the US dollar index or DXY and why this 99.50 level is so important. The DXY is essentially a scorecard for the US dollar. It measures its value against a basket of 6 major world currencies: the euro, Japanese yen, British pound, Canadian dollar, Swedish krona, and Swiss franc. When the DXY goes up, the dollar is strong. When it goes down, the dollar is weak. Dropping to 99.50 is a big deal. Why? Because historically, the 100 to 99 range has been a huge psychological barrier. Every time the dollar has decisively fallen below this level, it has triggered dramatic shifts in the global financial landscape. We tend to see commodity prices like oil and gold start to climb. Global liquidity, or the amount of money flowing through the system, improves significantly. Emerging markets suddenly look more attractive to investors and start drawing in more capital. And overall, risk appetite across the board increases. So a drop to 99.50 isn't just a number, it's a trigger point, signaling that major economic changes could be just around the corner. Now here's where things get confusing. If the dollar is weakening, you'd normally expect the market to be pricing in more interest rate cuts from the Federal Reserve. A weaker currency often goes hand in hand with looser monetary policy, but right now, the exact opposite is happening. So why are rate cut expectations falling? There are 3 key reasons. First, the US economy is proving to be much stronger than anyone anticipated. Recent data shows a surprisingly robust labor market, solid consumer spending, and resilient GDP growth. This strength means the Federal Reserve has no urgent reason to start cutting rates to stimulate the economy. Second, inflation is cooling down, but it's happening too slowly for the Fed's comfort. While the headline number has dropped, core inflation, especially in stubborn areas like services, housing, and wages, remains well above the Fed's 2% target. This slow decline makes the Fed extremely cautious about cutting rates too early and risking a second wave of inflation. Finally, the Fed officials themselves are sounding more hawkish. In recent speeches, various members have signaled that any rate cuts will be fewer and will come later than the market initially hoped. Some are even open to holding rates high well into next year. So even though the dollar is weakening, the Fed is putting its inflation fight first. So, if the Fed is staying hawkish, why is the dollar falling? This is the other side of the puzzle, and it has everything to do with what's happening outside the United States. There are several global factors pushing the dollar down. First, other major central banks are becoming more aggressive. The European Central Bank and the Bank of England, for instance, have recently shifted to a firmer, more hawkish stance on their own inflation problems. This closes the interest rate gap between them and the US, making their currencies, the euro and the pound, stronger relative to the dollar. Second, the demand for the dollar as a safe haven asset is decreasing. The dollar typically strengthens during times of global tension or crisis because investors rush to its perceived safety. But lately, some geopolitical fears have eased, and financial markets have become calmer. As a result, investors are feeling more confident and are moving their money out of the dollar and into riskier assets. The dollar is losing some of its safe haven premium. And third, we're seeing simple profit-taking and repositioning. The dollar was strong, arguably overbought, for many months. Now, large fund managers are closing out their long dollar positions, rebalancing their portfolios into riskier assets, and redirecting funds toward emerging markets and commodities. All of this activity creates significant downward pressure on the dollar's value. Now let's get to the most important part, the global impact. Why does a weaker dollar matter so much to the rest of the world? This is where the story gets really interesting. First, global debt becomes easier to manage. Many countries and international corporations owe debt that is denominated in US dollars. When the dollar weakens, the real value of that debt shrinks in their local currency terms. Loan repayments become easier, giving governments and businesses crucial breathing room. This improves overall global financial stability. Second, commodity prices tend to rise. Most major commodities like oil, gold, and copper are priced in US dollars. A weaker dollar makes them cheaper for countries using other currencies. This boosts demand, which in turn pushes prices upward. This is a big reason why we're currently seeing upward momentum in gold, oil, industrial metals, and even agricultural commodities. Third, emerging markets become magnets for capital. With a weaker dollar and a stable global environment, investors start searching for higher yields. Capital flows out of the US and into emerging economies, strengthening their stock markets and their local currencies. Fourth, global trade volumes tend to improve. A cheaper dollar makes US goods and services more affordable for the rest of the world, which can help boost global trade activity. And finally, for those of you in the crypto space, this environment tends to be bullish. Historically, assets like Bitcoin have performed well when the dollar weakens, liquidity improves, and risk appetite increases. This is why we're seeing renewed upward momentum in the crypto markets. So what can we expect to happen next? Looking ahead, there are three main scenarios. The first, and currently most likely, is that the dollar continues its decline. If global markets remain relatively calm and other central banks continue to sound aggressive, the DXY could test lower levels, perhaps around 98 or even 97. In this scenario, commodities would likely continue to rise, and global markets would gain strength even as US rate cut expectations weaken slowly. The second scenario is a sharp dollar rebound. This could happen if we see an unexpected geopolitical shock, a sudden spike in inflation, or seriously negative economic data from another part of the world. In that case, fear would return, and investors would rush back to the safety of the dollar. The third scenario is that the dollar moves sideways, stabilizing in the 99 to 100 range. This could happen if the market simply decides to wait for clearer macroeconomic signals before making its next big move. To summarize everything we've talked about, the US dollar index falling to 99.50 signals a major potential shift in global markets. But paradoxically, rate cut expectations in the US are falling at the same time, thanks to a strong domestic economy and sticky inflation. This dynamic is being driven by factors outside the US, like other central banks turning hawkish and a general increase in investor risk appetite. The global impact is significant. It means cheaper global debt, rising commodity prices, stronger emerging markets, and a boost for risk assets like crypto. We are entering a fascinating period of shifting capital flows and changing monetary dynamics. This is a key moment for investors, traders, and policymakers worldwide to pay close attention to. If you enjoyed this analysis and found it helpful, please don't forget to hit that like button, leave a comment with your thoughts, and subscribe for more content like this.